So the next aspect we need to look at is the future cash flow. Uh, Cash flow. Don't forget we are valuing the business of ZL, right? So what will be the future cash flow? What should they be expecting in the future in 10 years, right? Then with that, we need to start with the profit. You know, ideally we're supposed to start with profit after tax. Class, please pay attention to this part. Ideally, we are supposed to start with profit after tax, right? But because there is an acquisition, there will be a possible acquisition, right? There will be a possible acquisition, and that possible acquisition will make some things to change because there are some items that we're supposed to tax based on the acquisition effect from the additional information given to us. So it will not be good like that for us to start with profit after tax. No, we have to start with the profit operating cash flow before tax. Then we add all those post acquisition effects, the acquisition effects that they said the some of them is pre-tax, some of them is pre-tax, right? So we need to like add them then before we now do the total what we now do the tax, right? Ideally we're supposed to start with profit after tax, but if the acquisition take place, there are some things that will happen. Like, please take note of profit pre-tax operating cash flow of 53,000. Please take note of that. So what are the possible acquisition effects, right? Can you see it? So there are some here that it is like this pre-tax annual wages. Like this annual wages now, it is pre-tax. We need to consider it, right? So we need to do what? We need to consider it. So we need to add it with their profit because with their cash flow, right? Because it is a savings to them. Then we can now charge tax in full after we have considered the possible acquisition effects, the possible acquisition effects, right? And so we are starting with operating cash flow. Then we need to add back the possible acquisition effects so that we will know that, oh, this is their cash flow. Then we do the tax. Then we have net operating cash flow after tax. After that, there is no capital allowance, there is no tax savings. After that, what next do you have? You discount it to the what? To the present value, right? How do you discount it? Don't forget, they said the acquisition period for what is it called? The other one is for 10 years, right? The relevant cash flow for 10 years. When you
Okay, thank you, Ivy. I want to ask this rule you give us, is it a general rule? Like when there is an acquisition, we need to start with pre-tax operating profits. Is it a general rule or is peculiar to this question?
it is it may be a general rule and it may be peculiar to this question. Why did I say so? It's because ZL want to value their business. What did they have before the acquisition? That is pre-tax cash flow. What did they have after? What will be the effect after they say, okay, they want to sell this business, right? So that they will use it to determine what they will what they will quote for KK before the acquisition. What did they? Okay, if at all we want to sell the business, excuse me, we want to sell the business, right? After that, oh, excuse me. Thank you, thank you. So they want to sell the business now. One thing you should know about valuation of a business can come in any format. This is this is another way. But in another perspective, let's go in a practical aspect. You have a business. Someone wants to take over the business. Now, if the person wants to take over the business, what did you have before the takeover? Now, what benefits will you have after this person acquired this business? So you are looking at two things. So you need to add what you have before and the possible advantage of that acquisition. Then you discount to get your present future cash flow that you will say, oh, this is the amount or this is the value of my business, because you want to get the value of the business before, you want to get the value of the business after. So what's that is because that is one of the advantages of what? Of merger and acquisition, right? Because you want to know what will be the value of the business at the end of the period. You get ideally, I don't think there is no acquisition. This thing we would have started from profits, net operating cash flow. Then after net operating cash flow, we can discount it, right? Once we discount it, we get our present. If there is any scrap value, if there is any capital allowance, or if it is in line with free cash flow to equity, they give you working capital. Once you just see working capital will increase capital expenditure, you should know that, oh, this is either free cash flow to equity or free cash flow to the firm. Which at the end of the period, at the end of the question, they will state it that okay, this is free cash flow to what, to equity. But if it is not stated, you will see that they will give you information about only equity. They won't give you for debt. Do you get that?
Yes, sir.
I hope I've answered your question, right?
Mm. Okay. Let's continue.
Okay, that's fine. Okay, Mr. Moses.
So sorry, I didn't really get the reason why we are not starting from that profit after tax.
So if you
When
start
you
from
explain,
wait, I'm coming. See, that is why I said this thing is it is just it is just an understanding. You have you will have a savings with tax. Where do you want to keep that savings of with tax? There are two ways you can do it. I can decide to start from profit after tax. Then I will tax I will tax this pre-tax savings, this wages savings, this amount of savings that they will have, these savings, I will tax it. I will just apply 20% or 30%. I will tell you that it is tax on the savings. But I don't want to go through that stress. That is why I said, don't leave the profit after tax. What is the profit after tax? It is just the tax that is there. Is that not so? It is just the tax that is there. Start from the operating cash flow. Then add the savings that it is yet to be taxed, the pre-tax. It is yet to be taxed. Add it. Add any other one that is yet to be taxed after acquisition. Then you can now charge tax on it. It is still the same thing. I can decide that I want to do after tax. Then all those ones after acquisition that they are yet to tax, I will charge tax on them. Then add it to what they have. Add it to profit after what? Add it to profit after tax. Hello? More in class. Mm. Hello? I think the network
Yeah,
just.
it is clearer now, so thank you.
You see, that is why we, one thing about us is that we should always have alternative. We should always have an alternative. When I saw this question, I was like, okay, it should be like this now. Okay, we can also do it this way. And it works. It is not like this is the way you've been doing it, you must do it like that. I can decide to start from profit after tax. Now, after acquisition, they will have savings. That savings will add to them. I can decide that it is pre-tax. I will charge tax on that savings, then add it back to profit after tax. Any other one that is yet to be taxed, I will charge tax on it, add it back to profit after tax. It will give me total. Is that also, that is profit after tax. That is operating cash flow after what? After tax. I can decide that, oh, let me use net operating cash flow so that it will be easy for me that, oh, let me add pre-tax annual savings, wage savings. So if I add it if I add it to that, if I add it, then I can now charge tax altogether. It's still the same thing. Onyinye, do you get that?
Yes, sir. Thank you.
All right. Mr. Moses.
Thank you very much. I'm good.
Okay, that's fine. Don't forget that, don't forget that it was mentioned that the relevant cash operating cash flow are over a 10 years, right? Over a 10 years. Now the question is, okay, let's continue. Interesting. This is an interesting question, right? Now, okay, okay. You can see now, you were told that the operating cash flow is for 10 years. The relevant cash flow should be for 10 years. But they have to pay the directors. The directors, they are entitled to that is, if the acquisition take place, ZL will have an income, a cash inflow from the directors. That is, they will be paying the directors. So it will be a cash inflow to them. They will be paying the directors for 3 years. And the question says we should present the operating cash flow for 10 years. So which means that this this 3 years period, it will just be for the consultant. We will get there. Right? We will get it. It is an interesting question. Right? Very technical question. But guess what? We'll break it down. It's a very technical question. But okay, let's start. Let's start. We always have alternative, right? That is why we are next gen, right? We always have alternative to question. So let's say three, right? Three. Oh, okay. The first thing you need to consider is operating operating cash flow of ZL before acquisition, pre-operating cash flow. Let me use pre, right? Okay. Okay. Crap, let me use pre. I need to bring this one down maybe small. Okay. Okay, what is the pre-operating cash flow? Before pre-operating cash flow, figure please.
53,000.
53,000, right? So the possible effects after acquisition. Okay, okay. You that you want to take over class, listen, oh, you that you want to take over a company, then the company that you want to take over is telling you that first, our value before you take over. Then, when you take over our business, what is our gain? So the addition of these two together, when you discount them, will give you the present future cash flow that ZL we now quote to KK that Oga, pay us this amount. So it is not left for the board to say we are not paying you, we are paying you this, we are not paying you this. And that is what it means, right? So it is okay, it's kind of it's a technical question, right? But it's nothing. So we have a redundancy, which is a cost, right? The redundancy fee will be like a cost. Is that not so? That is after tax, right? I can count this. So I can come in another format, in another way, that this redundancy will be before tax. So when a redundancy fee is before tax, so what it means, you have to net it. You have to get the net of it. Why do you have to get the net of it, class? Don't forget that in a cash flow, you said your revenue minus your costs. When you see your revenue minus your cost, you have what? You have a net cash flow. From your net cash flow, you charge tax. Is that not so? Now, that tax you are charging on net cash flow, it is as if it is on both the sales and the costs. Class, am I communicating? That sales, that cash, that tax you are charging on the net cash flow before tax, it is on both sales and what and the costs. Get that? Because the difference between the two that gives you what? Net cash flow, which means that sales and cost is inclusive. Class, am I communicating? So I can decide that I can decide that this redundancy fee is before tax. So which means that you need to net it. You need to get the net cost of it, right? We'll get to that side. So this redundancy fee is a cost. It is a cost to ZL because ZL will pay their staff, right? Of course, it will form part of what ZL will quote, right? That is why they say effect, possible effect, right? So redundancy. So that one is separate. We can put that one separate, right? Because they said it is after tax. So I didn't mean it is before tax. We would have as well consider the redundancy. So let me just put this redundancy fee down. Redundancy fee. What is the redundancy fee? How much is it?
500,000.
You say?
12
Yeah,
million.
now 12 million, right? See, I beg. Make una just tell me the this thing, right? Abeg. I no get strength, abeg. So, uh, we've got quickly go back to the question. We've removed this part that this will be the cost. It is after tax. If you pay attention to this part, you understand it. Just pay attention. Then it is a cost. We don't need it now. We don't need it now because it is after tax already. We don't need it now. Now, annual wage savings are expected to be 7.5 million at the current price for foreseeable future. Of course, it is your operating profits is based on the current price, right? And this annual wages savings, that is a cash inflow to ZL. They will save as a result of they don't pursue some other stuff because of they pay them redundancy fee, then they will have savings. And this savings is pre-tax. That is, you have not charged tax on these savings. And don't forget, the savings is like an inflow, right? So, what is the amount? What is the oh gosh. What is the this thing self? Annual savings, right? Annual wage savings, abi? So it is pre-tax. You've not charged tax. What is the amount, class? Figure
7.5.
7,500. You know, you've not charged tax on it. That is why it is like this, right? It is pre-tax. Then, which other inflow do we have? After that, which other inflow do we have? Oh, we have some land and building. It is after tax. This one too is after tax, right? Sales proceed on land and building, 8 million. So let me put it somewhere. Let me put it somewhere. I'm not using it here. Sales proceed on land and building, right? So after tax, what is the amount? 8 million, right?
Yes, sir.
Okay. Now, the only thing I'm picking is the one of before tax. That is the one I'm picking in the other side, right? The one of before tax. Now, I've picked that. Then, what next? We have advertising and distribution savings. It is pre-tax. You are here to charge tax on it. Pre-tax. Do you know why I'm doing it like this? It's because I want it to be very easy for you, right? For everybody, right? Now, don't forget, I said ideally I should have started from profit after tax. If I start from profit after tax, I have to net this thing. I have to charge tax on 7,500. I have to charge tax on the advertising because it is an inflow to them. And that will give me a lot of stress. I don't want to do it like that. I never say, okay, let me change it. Let me start from operating profit cash before the tax. Then let me add all pre-tax cash inflow. If I add all the pre-tax cash inflow, I can now charge tax on everything. Bam. Class, am I communicating, please? Am I communicating? Okay, okay, that's fine. Advertising Is it savings on advertising or what should I even call this thing itself? Advertising and distribution
Just
savings,
Distribution
right?
savings. Yeah.
Thank you. Advertising, distribution, say, all these are pre-tax, so, right? Pre-tax. You can see that is because of the possible effect of acquisition. That is why the methods looks like it looks somehow, right? It looks somehow, right? It is because there are some benefit, there are some cash inflow that is yet to be taxed, of which we need to consider that. So what is the figure?
1,500.
1,500. So is that all? Do I have any other one that is a cash inflow?
sorry,
Do
it's
we have any
1.50.
okay,
1.50 million. That's 1,050,000.
500,000. That is 1,500, Abi? Is it
Sorry,
1,000 or 1,000?
1.50. Abi?
I'm confused. 1.50 million, it means what? Is it 1.5 million? Abi? Or is 1,050,000?
No, 1.5 million. That's 1,500. It's correct.
Okay, stop. Oh no. Okay. Which other parts? Which other parts? Okay. Another one is the three existing directors of ZLE would each be paid 1 million for 3 years for consultation service, for consultancy service. So which means that if the acquisition take place, right? If the acquisition take place, right? So ZL will still include this cost, right? We include it as part of its own inflow because they will receive the consultancy fee, right? From KK. So when they want to quote, they have to do what? They have to include it. So this means that consultancy fee in law, in let's say, it will only attract withholding tax. Is that not so? It's there under the withholding tax regulation of 2024. Even before the withholding tax of regulation of 2020, consultation fee, consultancy service, you don't need to charge tax on it. Will you charge tax on consultancy service? No. Why? Because the business itself is subjected to tax. And the directors, who are the directors? The directors are the owner of the business. The only thing that they will, as AKK will now do is that, this consultancy service, okay, Mokuna, no worry. We'll remove 10% withholding tax on it. Bam. Class, am I communicating? Okay, that's fine.
Yes, sir.
Onyinye, are you still in this class? Are you still
Yes,
with us or against us?
I don't understand. I'm with you, but this thing is not clear. Now, this consultancy service, normally, yes, you're meant to charge withholding of 10%, you know. Now, but like you explained that the company is already taxed, does it mean when they charge it again, is it not double taxation? I didn't even get what you explained now, seriously.
I say we are not charging it now. I'm not bringing it in. I'm not
Okay,
bringing it in. That is what I'm trying to explain.
okay, okay.
Mhm. Okay, so we move to, okay. What is the total?
9 million.
9 million tax. How many percent is the tax? How many percent is the tax?
33%.
Eh? Let's check. Oh, where is the tax? Where is the tax? Where is the tax?
33.
33. Okay, that's fine. Exclusive. So you did this class. Your face show. Your shoe shine. Don't tell anybody. Oh. 33%. Exclusive. You didn't say anything.
So are they
Where
so I
you
come and
where
eat
if
carrots. I'm I know the that traffic was crazy.
So 33%. So when you charge 33%,
Sir, the cash flow before tax.
Yes, we did not add it exactly.
ah, so now the one where they give me, oh, what is the cash flow before tax? Oh,
It's 53. Everything is
60,000.
62,000.
62,000. So, you know who give me figure. Oh. What is tax? Charge the tax. If you charge the tax, what do you have?
20,469.
20,000. 20,000 what?
460.
For
60.
so what is profit after tax? The cash flow.
41,540.
You say
41,540.
41,540. Go and check performance of this particular question. Everybody attempt it. You see these 10 marks, 10 marks and 7 marks, 17 marks. It was difficult to. Now, class, let me open your eyes to something quickly before we continue. And that is why it is always good when you are reading your required, pay attention to. Now, the question says that the present value of relevant operating cash flow over a 10 years. Class, over what? The present value of relevant operating cash operating cash flow over a 10 years. Relevant operating cash flow. Now, in this case now, from all what you just analyze here, it is an indication. Okay, we've not bring in directors this thing here, but that's fine. Now, it is an indication that this is your relevant net cash flow. This is your relevant cash flow. So, which means that when you want to present it, your relevant cash flow for the 10 years will be based on the 41,540. That is the relevant cash flow. Relevant cash flow. The sales proceed on land and building, it is after tax. The redundancy fee is a cost. The sales proceed on land and building after tax. It is sales proceed you sell from an investment, right? From your investment. Is that not so? Right? From your what? From your investment. Now, your cash flow, your 10 years operating cash flow, it is based on 41,540. But however, let's continue. Now, what do we have again? We have the three existing directors. Would each be paid 1 million for 3 years, right? Would each be paid for what? 1 million for 3 years. Now, class, this redundancy fee is like, it is like, it is like, how should I put it? It's like year zero. It's like we want to dispose you. We want to buy over Next Gen Academy. We need to pay staff redundancy fee, right? It is a cost. You cannot say that cost is year one. You cannot say that cost is year two. You cannot say that cost is year three. You cannot say the redundancy fee is for 10 years. You cannot, it is not specific to 1 year. So you can say, oh, this is just year zero. But I'm just telling you, right? The sales proceed, you cannot tell me that the sales proceed is for year three. The sales proceed is for year 10. The sales proceed is for year 4. Because it wasn't mentioned. It is one off. Class, it is what? It is one off. Am I communicating, please? It is what? It is one off. Right? Now, my point here is, let's quickly move to the part of the part of where is it? Directors. Now don't forget, the directors of will be paid this because of course ZL will add it as part of their cash inflow that okay, the director will receive this. So when they want to value the business, they will add it together so that you will pay them, right? You will pay the director, right? This amount will not increase with what? With inflation. Then, mind you, don't forget, all these figures here are on their current price. Oh, do you know? All these figures, you've not inflated it. They are all on their what? On their current price, right? They are on their what? They are on their current price. Is that not so? They are on their what? Current price. Now, the directors. Let's quickly move to the part of the directors. The directors. Let's just put this one here. The directors, right? Cash flow for three for three for 3 years. Director's cash flow for 3 years is 1 million, right? For 3 years. So it is 1 million per year, right? 1 million times 3 for 3 years. We give you 3 million. 3 million, right? We give you 3 million. Class. Of course, if this give you 3 million, class, are we still together?
Yes, sir.
So we're here, we're just using our brains.
How do I explain this? Uh, but you understand it to this part. I need to confirm. We understand it to this part.
Yes, 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 sir. Yes.
Okay. How do I explain this part again? Okay. Okay, that's fine. Okay. Director's cash flow for 3 years is 3 million, right? But then, but then, I have two things to explain here. I don't know how I'll put this part. Uh, where is it, sir? Directors. Okay, the directors existing, the three existing directors, right? Do you know why this will not form? Ideally, this consultancy fee. Now, but do we understand that net cash flow? First, please confirm if you understand that net cash flow, that net cash flow after tax. Do you understand that part? Thank you. Now, do you understand that the redundancy fee is a cost? That redundancy is a cost to the firm. Do everybody agree with me? Okay. Now, directors now is the major problem. Now, why we need to separate this directors fee is because the directors is for what? We receive cash flow for 3 years, right? Now, since director we receive cash flow for 3 years, our net cash flow we assume to be 10 years. Ideally, we would have take this consultancy service and put it in that possible acquisition. We remove tax. We remove tax. Then we get net cash flow after tax. That is what we're supposed to do. But there is a clause that it is just for 3 years. So we will not add it. It will not be part of it at all. Because that other one, we go for 10 years. Why this? We only go for what? We only go for 3 years. Now, I made a statement that time. Let me quickly, I will take back that statement. I think it is actually wrong, right? ZL, let's say KKPLC. Kwemisire, are you, are you still in this class?
Yes, yes, yes. I'm here. I'm here.
Okay, that's fine.
Thank you.
KK want to take over ZL. The ZL is now standing on the ground that, oh, if this acquisition occur, you will pay us, you will pay our directors 3 years consultancy services. Now, when you are doing your computation, these 3 years consultancy services will suffer what we call double taxation. We suffer what we call what? Double taxation. That's why I say I take back that my statement. I just remember something now. That even dividend that they charge you, the dividend you invest in Zenith Bank, you collect dividend, right? You receive dividend. That dividend is net of withholding tax. Of course, Zenith Bank will still pay tax. Is that not kind of double tax? But the only thing is that the withholding tax will be used to offset your own tax liability. Why? The one that Zenith Bank pay is their normal tax. Can you see it? Can you see that it's kind of double taxation? But the other part have a benefit to the company. So what I'm saying here is that this consultancy fee, consultancy service, will form part of the inflow of ZL that they will pay the director. Now, they have to tax it because it is part of their cash inflow. However, it is two ways. However, when KKPLC want to look at the bid and say, oh, this consultancy service, charge 10%, we'll give you the balance. Of course, ZL, we present tax, we pay tax. right? When ZLA is presenting his tax this thing, it will include that, okay, there's a consultancy service that will receive that forms part of what their income, that form part of their inflow. Is that also which will be which will be what taxable? Class, am I communicating? So this 3 million, we will subject it to what? We will subject it to tax. Ideally, we were supposed to add that 3 million to that net cash flow after tax, before the tax and other. But because this is just for 3 years, the directors is just one of it is just for 3 years. It is not for what 10 years, right? So in this case, we will we will charge wait we will charge uh wait so we need to get the net. I can do it this way. So you say tax 33%. What is the 33% of this? What is the 33%? Give me figure. What is the 33%? Give me figure first.
990.
9,
990.
is it 990 million or 990,000?
1,000.
So what is the net when you remove it? When you remove it, what do you have?
2010.
Okay. What do you have?
2010.
Okay, I'm coming. 22.
10. 2010.
Okay. Now, okay. Now, class, let's quickly go back. I'm coming. Question. Let me quickly question. Let me quickly go back and show you something. Now, let's quickly go back to capital budget. Class, when a figure, before I continue, when a figure is quoted, class, if you check the material I sent on capital budget, I mentioned that when a figure is quoted and this figure did not state whether it is current, whether it is current price, right? Whether it is current price or it is not current price, right? It is assumed to be a real it is assumed to be a real cash flow, right? When a figure is being quoted, they didn't tell you that this is current price of this particular, like now they say some land and building, it is real because it wasn't stated that it is current price, right? Then which other one? The directors, it wasn't stated that it is at current price. You see all those ones that is at current price, these are the what? These are the nominal, right? They are what is it called? They are nominal cash flow. Is that not so? Then those ones that does not indicate, right? In this question, it wasn't indicate that, oh, this is nominal or this is real. It is assumed to be a what? A real cash flow. So therefore, your redundancy cash, your redundancy cash flow, right? Your redundancy cost is real. your sum land and building is real, while the director's salaries as well being paid is also what? Is also assumed to be real, right? Mr. Moses,
Hello, sir.
I'm with you.
Okay, my question on this, your explanation on this director taxing it again. I think
Have you?
that true is
Okay,
going to
okay.
be double taxation.
How?
That explanation.
You
Why
say?
we are. I'm not really clear with the explanation and tax egg feed them. I'm not really clear why we are still tax.
Okay. Any other question? Any other question?
My second question is figures are in their real terms. Do we put them down as part of our assumptions?
If it is actually stated,
If it's not stated, let's say the
if
examiner is silent.
if if the examiner says state the assumption, just state your assumption. If the examiner did not say state the assumption, you can ignore. Then if you want to state it, you can decide to state. Sir Moses,
Yes, sir. I'm here, sir.
do you get that?
Yes.
Okay. Any other question again? That is noted. The first one is noted. Any other question again? Any other question? Okay. That's fine. Okay. Mr. Moses, you have a
Yes, sir.
business. Enough of English. Enough of what? English. I know this question will bring a lot of problem and there will be a lot of back and forth. But then it is what it is at the end of the period, right? It is what it is. You have a business and someone wants to take over the business. Now, when you are analyzing your cash inflow, if there will be a possible acquisition, they have to pay your directors, including you, 1,000. How would you recognize that? Won't you recognize it as part of your inflow?
Sure. Sure, I will.
Thank you. You will recognize it as part of your inflow.
Yes.
And this is merger and acquisition. You will recognize as part of your inflow. Is that not so? Now, when you want to charge tax, will you remove because because that money, that fee, as you see, it is what we call other income. Is that not so? It is other. It is not from the business. It is possible. Other income will be taxable. That is why I have explained that ideally I'm supposed to add it to all those possible acquisition, but because it is for 3 years, right? It is for 3 years, right? That is why I was not able to say, okay, let's add it, so that we can charge tax all together. I've equally explained that there are two ways to this. As a business, you pay tax on it. Before you will receive that consultancy services, KKPFC might have removed withholding tax for your own benefit. Do you get that?
Yes, I'm with you, sir.
Do you understand it now?
Yes, yes, yes.
Any other question?
The call is ending
Yeah.
in 2 minutes time.
Are you still with us?
So I'm here. I'm just waiting to see the outcome. I pray for understanding.
Well, that's fine. You just have to go back and check it so that it is what it is at the end of the period. So once we will complete it, ah, we'll complete it, right? If I didn't complete this question, I will just abandon it. So either we choose to
Sir,
end
sir,
it.
please let's continue. All the questions, maybe we can ask after the whole question so that we
Okay,
don't
that's fine.
take our time.
That's fine. That's fine. So let me quickly create another link so that we'll complete it. Immediately we come back, I'll finish the calculation, then you can ask your question. Thank you. Thank you.